If you're 50 and you don't have a retirement plan yet, this isn't just a gentle nudge. This is a blaring alarm, because what you do for the next few years can determine whether you stop working at 60 or 70. Most people think they have time, but they're playing a dangerous game. The window to catch up is real, but it is closing fast. So in this video, I'm going to be walking through 6 critical ideas that anyone in their 50s needs to know if they want to retire on time, maybe even at all. My name's Joe Bogan. I've worked on hundreds of retirement plan consultations over the years, and I have helped many who have felt behind turn that confusion into clarity, because the truth is generic advice isn't just unhelpful, it is potentially dangerous. Today, I'm going to be helping you to take back control, showing you some of the key mistakes to avoid and what to do instead. We'll be specifically going over what is a $1 million amount, what it means for you, why time becomes your biggest enemy after 50, what to do about it, how ignoring lifestyle could lead to regret later at your expected retirement time, and the most overlooked expense for retirement, and lastly, why retiring later is a risky solution to bank on. So first, who wants to be a millionaire? The most common belief out there is that you just need $1 million to retire. You've seen it in the headlines, you've heard it in conversations, maybe even you've told yourself that if you hit that number, you'd be safe. But here's the truth. This one-size-fits-all figure is not just misleading, it's potentially very risky. And it comes from the 80s and 90s when being a millionaire meant a lot. It was worth significantly more than what it does today. It was basically a high enough benchmark that it covered most people in most circumstances. But because of inflation, it's hard to say if $1 million is enough for any individual without much context. Today's conditions don't hold up to yesterday's assumptions. Even if we just adjust for inflation and call 2.5 million the new million, this obsession with a magic number creates 2 major problems. First, it paralyzes people who haven't hit it, leading them to assume they're far behind and can't even retire. And second, it gives a false sense of confidence to those people who've hit that number without examining if that amount actually fits their lifestyle. So how do you do this? How do we fix this? You stop focusing on what friends or everyone else is doing. You start getting clear about what you need. Instead of asking, do I have $1 million? Ask, what does my retirement lifestyle cost per month? That's the number that matters. Start with an analysis of your expenses, housing, healthcare, food, travel, and build from there. Then create projections based on a conservative withdrawal rate, say 3.5% to start, to determine how big your nest egg and actual savings target needs to be. For some, it may be less than $1 million, and for others, it may be more. When I work with clients, we don't chase arbitrary figures. We chase clarity, because knowing your number, your real number, is the only way to stop feeling so anxious and get a sense that you're in control and on target to where you need to go. But even if you do have clarity on your number, there's one silent force that keeps people stuck for years, and it's not about money, it's about time. Let's talk about one of the biggest hidden dangers in retirement planning. It's waiting for certainty. For most people at 50, life may be crazy and they haven't saved enough, and they think, why not just wait till I have more confidence, more saved up to start planning? It could sound responsible, logical, and even smart, but it can lead you down the wrong track. And that's not just theory. According to the National Retirement Risk Index, in recent years, more than a decade after the financial crisis, 47% of Americans are still at risk of not being able to maintain their standard of living in retirement. That number has barely moved from the years immediately following 2008, when the markets have been on a tear. How could this be? Well, the problem isn't necessarily how much you saved, it's whether or not that savings actually supports your life. You tell yourself, once I know the numbers, once the market settles, once I figure out the mortgage, that's when I'll act. But here's the truth. Waiting until you're sure is actually the riskiest move you could make. The reality is there's no moment where everything's just going to click and fall into place. There's no perfect time. And that mindset of just waiting for clarity before taking action costs people the very thing they are trying to protect. So that's their time. Here's why that's so dangerous. Once you've hit 50, time is no longer your ally and starts working against you. Every year you delay planning or decision making shortens the runway you have to grow your savings, fix gaps, and pivot when something goes wrong. People forget you're not just losing time, you're losing opportunity costs and maybe even significant options. The closer you get to retirement, the fewer tools that you're going to have available to make up ground. You can't just outsave a 10-year delay in a couple years. You can't undo a missed decade of planning. And most importantly, you can't buy back the years you didn't plan with intention. So instead of waiting for certainty, build a plan that welcomes uncertainty. Start with a rough draft, create different working versions of your retirement timeline, even if you're sure it's not 100% accurate. Just you start by mapping out your income, your current savings, your target retirement age, and run the numbers. And here's the key. You've got to review and revise a few times a year. Planning is not a one-time event. It's a system that gets better with movement. And when clients stop trying to time it right and they start trying to just get something in place and then improve over time, they can begin to move from fear to clarity, from waiting to building. And that's the moment when everything shifts. You stop chasing perfection and just start adjusting with purpose. And if you're still not sure whether your current plan is actually moving in the right direction and maybe confusing on how all of this stuff applies for you, check out the link below, which offers the opportunity for a free strategy call with me. We offer these to give people a personalized sense of feedback on where their opportunities are, where their risks might be. But be sure to click that now because meeting spaces fill up fast and we only have a limited amount available. Now, back to where most people still get tripped up. And it's not about how much you've saved, it's about how much you'll actually spend. One of the biggest mistakes people make in their 50s, they assume retirement will cost less than their current lifestyle costs. No more commuting, no more work lunches. Sounds good, right? But here's the truth. Overconfidence in retirement frequently stems from inadequate spending assumptions in retirement. It's one of the ways to blow up your financial plan is overspending. The problem isn't just math, it's bad psychology. People don't factor in what they will spend once they have the time and freedom in years ahead of them in retirement. And what happens with freedom? Potential for more expenses. And here's what the research shows. Lifestyle inflation is when your spending rises as your income does. According to Investopedia, this is why so many people continue to live paycheck to paycheck despite high earnings. And a publication known as Very Well Mind points out that this lifestyle creep is triggered by emotional spending. It's not logic. This is especially relevant for people in their 50s, as they may be reaching their peak earning years right before retirement and expanding their lifestyle. In retirement, this pattern doesn't just stop, it evolves. There's travel, there's home upgrades, there's supporting family, and boredom spending. All of this can quickly inflate a bare bones budget. And that's not all. Investopedia reports that 45% of retirees face stealth costs, unexpected expenses like healthcare gaps, home repairs, or inflation can quietly erode savings. And these costs aren't dramatic, but they can compound and they are not frequently prepared for correctly. One study found that falling behind in their financial planning, known as low future orientation, leads to higher stress levels and was even associated with higher mortality risk. Researchers don't know exactly why this is, but it seems pretty well believed that having a well-vetted financial plan has a strong connection with long-term well-being. So how do you avoid this trap? Well, you start by facing your lifestyle costs head on. You track your current spending over the next 90 days and be brutally honest about it. Ask yourself, what would I change if I retired tomorrow? Would I travel more family time, more hobbies? Translate those desires into real numbers. What would each month realistically cost in your ideal retirement? Once you know that number, you know you're not planning for an illusion. You're planning for life. And that's where retirement becomes possible. But even if you plan for lifestyle expenses, there's one category most people completely overlook, and it's often the biggest budget breaker of them all. In fact, researchers show the average retiree spends over $150,000 in retirement health care alone. And for a couple, that's upwards of $300,000. So often we assume Medicare will cover everything or that will just be manageable, but the numbers tell a very different story, and those numbers do not include the risk of needing end-of-life care or long-term care. And it's not just about premiums, it's about out-of-pocket costs, prescription drugs, dental care, vision, hearing aids, and long-term care, all of which are not fully covered by Medicare. And that doesn't even consider the fact that a really severe long-term care scenario at the end of life can swallow an entire retirement portfolio. These are some of what experts call stealth costs. It's because in your 50s, you're generally in good health and you're in an employer plan where a lot of the costs are covered, and you may be reluctant to consider risks that may or may not occur 30 or 40 years from now. But if you're not correctly estimating healthcare costs for retirement, this could result in a retirement plan being off in their assumptions by well over 6 figures. So how do you get ahead of this? Well, first, you have to treat healthcare as a separate line item in your retirement budget. It's not just an afterthought. You have to understand your options. If you're retiring before Medicare eligibility at 65, you got to research the ACA marketplace now. Know your premiums, your deductibles, your coverage gaps. And third, if you're still working, consider maxing out your health savings account. It's one of the only accounts that's triple tax advantaged, and the funds continue to roll over year after year. It will be available in retirement. And finally, don't ignore end-of-life care. Consider your options. Know how you're going to address this risk, even if that means self-insuring against these costs and factoring that into the target nest egg for retirement. The fact is, addressing this in your 50s means you have many more options that are available that may very well not be available if you try and figure it out 10 years later. But even if healthcare is under control, there is still one mental trap of procrastination. Many people in their 50s, they think that if they're behind, they don't need to make any adjustments or plan. They can just work longer. The idea is, I don't need to make any adjustments or plan because if I'm falling short, I can just work a few more years. And while that sounds reasonable on paper, relying on extended work as your primary backup is risky at best and perhaps unrealistic at worst. The truth is, many people don't get to choose when exactly they stop working. Health issues, layoffs, ageism, caregiving responsibilities can force people out of the workforce far earlier than they plan. And in fact, studies from the Employee Benefit Research Institute show that nearly half of all retirees leave work earlier than expected, often due to factors outside of their control. And when you build your plan around the assumptions you can work forever, or at least longer than may be realistic, you're betting your retirement security on something that you don't control. Here's the smarter approach. Build your financial plan as if you won't be able to work later. Treat any future work as optional. It's a bonus, not a requirement. Focus on getting on track now. Consider if you should be maximizing your catch-up contributions, optimizing expenses, and building a realistic retirement lifestyle. Then, if you do choose to work longer, that's great. That income becomes additional padding for maybe an earlier retirement, for maybe greater spending or greater flexibility or legacy. Work should be part of your retirement design, not your retirement lifeline. And if you're ready to stop guessing and finally build the kind of plan that works, even when life throws you a curveball, here's how you get started. If you're 50 or older and you're not sure whether your retirement plan is on track, a lot of these things can be confusing and it can be uncertain how this actually all applies to your scenario. I've got something just for you. You can click the link below and apply for a free complimentary one-on-one call where we'll walk through some basics on your scenario and determine where your risks are, where your opportunities are, and what next steps may be. There's no sales pitch, it's just feedback and a short guided check-in on your scenario. So if you're interested, click the link below in the description to learn more. And even for some of the most accomplished people feeling behind or unsure about how things may play out financially at 50, it's a lot more common than you think. But it's not the end of the story. It's just the beginning of the next chapter of your financial life. You don't need to have everything figured out. You just need to take the right steps first today, because every smart decision now builds a foundation for your financial future ahead.